Ladies and gentlemen, boys and girls, welcome back to Finance Tube. Since the last 2-3 episodes, I am seeing that the energy levels and the engagement levels of the channel has improved, just because not just my company and all of you, but our channel has got a new mentor, and I have requested him to continue with us for at least 2 more episodes because there is a lot of demand that is coming up. And friends, giving respect to your suggestions and demand, we again have GR sir here today. And I have this very pertinent question, which I don't remember where I got it from. I think one of the comments said that why can't GR sir tell us more about fiscal discipline and prudence, how it results into wealth creation, sir. So this time, no formalities, straight to the question. People are very eager and been waiting for this answer. So why don't you tell us, sir, that how does fiscal discipline and prudence help in generation of wealth?
First and foremost, Vishal, this is a very, very critical question. And I would love to tell the viewers here that wealth creation is not an easy job. First and foremost, when we want to create wealth, we need to know what are our goals. Our goals are going to be very clearly defined. In that sense, you need to have a short-term goal and a long-term goal. You need to say that these are the assets in which we will be investing, and these are the reasonable returns that we are expecting. There is something known as a risk-reward ratio. Higher the risk, higher the return. Lower the risk, lower the return. That doesn't mean that we put all our eggs in one basket and go for a high risk, high return methodology, or we go into a low risk, low return methodology. We have to have a fine balance between the two. For this, what do? We need to first be saying that we earn so much and we need so much of our money on a monthly basis for our normal day-to-day comfortable living. After that, we have something which is known as a surplus, which is there in the system, and this surplus has to be invested judiciously and with prudence. What do we mean by saying it should be judiciously done? We cannot be saying that this surplus will be invested into some instrument which will give you returns of, say, 30% per annum. The moment you hear someone say that I'll give you 2.5% per month, beware. That's not wealth creation, because that is a very, very high risk and almost zero return that comes in your way. So please don't get into that. Those are the ones which are done in the film industry, and where the stakes are high, the failures are high, and there is every chance that your money will never come back to you. So avoid that. What are we supposed to do? We are supposed to look at different types of investments. Divide it into 3 categories. One should be investments in the real estate. Second should be investments into your debt funds. And the third should be investment into equity funds and SIPs. Now, if you were to make a judicious division, I would suggest that you should put 40, 30, 30. 40% you can put in real estate in a small way. 30% the rest too, because you need to be having some real estate in your system, like start with a small house, which is a roof over your head. And if you don't even want to live in that house, you can give it on rent, which gives you a year-on-year return with an automatic escalation attached to it. So you're getting the inflation adjusted return every year on the rental income. That's one. Second, when you're investing in debt funds, you're going to get a tax-free dividend in the form of debt funds returns. That's very useful. You don't have to pay tax. And the third one, what you need to do is you have the equities and the SIPs, which give you that extra return, but with not a disproportionate rise in the risk in terms of what you take as a risk in the system. Your risk appetite has been actually taken cognizance of, and then you've gone about investing it. Now, if you look at this pie chart, it'll be very interesting to see that you are slowly into creating wealth through movable and immovable assets. The immovable assets obviously is the real estate, and the movable assets is the debt funds, which can have capital appreciation, and the equity funds, which obviously are for capital appreciation, less for dividends, more for capital appreciation, more for wealth creation. And if the wealth is to be created the right way around, we have to go for winners in the equity funds, where the fund managers are critical. You need to see whether they are doing value investment or momentum trading. So that part of the research, you have to do it as far as the debt funds and the equity funds are concerned. And as far as the real estate is concerned, one caution: never go for under construction. Even if you pay a little bit of a premium, go for one which is nearing completion, so that you know that the asset is going to come in your hands soon, and it could be earning an income sooner than later. So according to me, fiscal prudence and financial discipline can really ensure that you are into a wealth creation mode, and the habit of saving, creating a surplus, will automatically infuse a sense of discipline, and you will be creating wealth unconsciously, automatically, for you, for your family, and for the well-being of everybody near and dear to you. Thank you so much.
I think that step-by-step pertinent solution is what all my viewers were looking at. Thank you so much, JR, for gracing us with your time. And we are really delighted to have you here. A lot of my friends, in fact, after the last episode, called me and said that this is going very well. Why don't you continue doing it?
It's a pleasure. It's a pleasure, Vishal. Thank you so much. Anytime I'm there, anywhere I'm there for Contitra as a mentor. I'm around here to help you in this journey of yours in the finance.
Thank you so much. I feel
pleasure.
honored.
Thank you so much.
Thank you so much, friends, for tuning into today's episode. And if you haven't subscribed to our channel, please do subscribe. And I'm going to take a sneak peek on 1 or 2 more episodes with Sir, because he has gracefully accepted it. So subscribe to our channel today, our channel, Finance Tube.